At some moment in our lives, many of us decide that it's time to begin to invest. But there are always questions. Where do I begin? What brokerage do I use? What is the difference between stocks, cryptocurrencies, and ETFs? What minimum amount should I invest? How much should I invest? And many more questions like that. In this video, you will learn how to begin to invest, why it's important to start early, what inflation is and how it kills your money, what compound interest is, how stocks and ETFs work, and many other things. It's going to be a complete guide to answer the majority of questions that you might have in the beginning without using too many financial terms. I should also point out that none of this is investment advice, but rather an overview of how investments work in general. You can also leave your questions in the comment section below, and I'll be happy to answer all of them. The first question that you might ask yourself is, what happens to your money over time? And why do you need to invest at all? And the answer is inflation and compound interest. You've probably heard about inflation a lot in the news for months now. Inflation is the rate at which the general level of prices for goods and services is rising, and your ability to purchase something is falling. For example, today we see inflation of around 6 to 8% a year. This means that for every $100 in savings, you're losing $8 a year unless you invest them in some assets. It creates a situation when everything in stores gets more expensive every day and your wage and savings are no longer adequate for the prices. Basically, you're getting poorer over time. Another reason to start as early as possible, as I mentioned before, is compound interest. Compound interest is the way your money accumulates over time, meaning the longer you invest and reinvest your gains, the more money you make. For example, if you invest $1,000 today with an annual return rate of 10% over 10 years, and you invest an additional $10 every month, you will almost double your money over the next 10 years. So what kind of investing options are hypothetically possible? First of all, you can have a savings account. Savings accounts can be a great option. They can be opened at any bank and are very easy to set up. However, holding money in a savings account doesn't help you much, as most of them offer 3 to 4% annual interest, which doesn't beat inflation much. You can also invest in real estate. You can buy a property and rent it out. Usually the value of real estate goes up over time. However, property management requires a high initial down payment and takes a lot of operational work with tenants and the property itself. You should also purchase at the correct moment and the right place, especially when the real estate market is falling like today. You can also start your business and invest in it, but starting your own business is even riskier and requires a lot of work to make it successful. The data from the US Bureau of Labor Statistics shows that about 65% of all new businesses run out of business within the first 10 years, and only 25% of new businesses make it to 15 years or more. You can also invest in cryptocurrencies. It didn't look like a good idea last year after a 50 to 90% correction of all coins, but with Bitcoin almost 50% up from the beginning of the year, it's starting to look like a good idea again. So does that mean it was a good time to invest before when everyone was scared? But nobody really understands what's going on with the crypto market, including large venture capital funds. For example, Andreessen Horowitz lost about $2 billion or 40% of their new crypto fund last year, so let's hope they recovered their positions this year. Finally, you can invest in the stock market. The stock market is one of the most liquid and controlled instruments available today. You can invest in company shares or stocks or ETFs. I'll explain these in detail in a minute. There are also bonds, different funds, options, and other niche types of investments. Please leave your comments below if you'd like to learn more about those. Usually people start with stocks or ETFs as more niche investment types require more trading experience. But let's get back to liquidity and control. Out of all the options that I described, like real estate, starting a business, investing in crypto, etc., the stock market is the most controlled and liquid form of investment. This means that you can enter the market or pull your money out of the market almost instantly. So if you need your money urgently or you want to invest more, you can do this at almost any given moment. The one thing you should avoid though is putting your money into risky assets which are volatile and whose returns won't match your investment horizon and risk profile. But we'll talk about this in detail a bit later. So what are company shares and what's the stock market? Company shares, also known as stocks or equity, represent a unit of ownership in a publicly listed company. When a company issues public market stocks, it's essentially selling a small portion of the business to shareholders. Those shareholders are entitled to a portion of the company's profits and have the right to vote on important matters such as the election of the company's board of directors, etc. Buying and selling shares allows investors to profit from the company's performance. When it's doing well, the price per share goes up. Also, some companies pay dividends to their shareholders. This means that for every share that you own, you get regular small payments. That amount is defined by the dividend yield, which is a percentage of the stock's price. So if you invest $500 in a company that pays dividends, you'll usually get a few dollars every quarter. Just like real estate, shares tend to appreciate over time as they grow with the company's capitalization. The investor's role in this game is to invest in successful companies that have the potential to grow their capitalization over time. I will describe the basics of picking stocks and ETFs in a few minutes, but first, let's look at ETFs. What is an ETF? An ETF or exchange traded fund is usually a collection of over 100 stocks by industry or the stock market as a whole. You've probably heard about the S&P 500. That's an index that tracks the largest companies in the US, created by the American credit agency Standard & Poor's. So an S&P 500 ETF tracks the performance of the S&P 500 index and allows investors to invest in all of the 500 largest and most promising companies in the US with just one simple transaction. S&P 500 ETFs are offered by many major brokers like Vanguard, Fidelity, and others. ETFs help to diversify your risks by putting money into different assets and rebalancing them. So hopefully that's clear. Now let's talk about brokerage companies. Let's say you want to buy shares of Apple. It's not that you just go to apple.com and buy shares there. You need to open a brokerage account with one of the brokers. Brokers have access to the stock market and place orders like buy and sell on your behalf. Back in the day, you would have to give your broker a call and they would place orders for you. You might have seen this in the movies. Today, you can do it with a mobile app. When you come to a broker, one of the main questions they'll ask is, what type of account are you looking for? There are different types of brokerage accounts. The most common ones are individual brokerage account and individual retirement account, IRA. The biggest difference between them is that the IRA is a retirement account that gives you tax deductions, but you should only put money in an IRA if you're willing to leave it there until you're 59.5 years old. If you withdraw money before that, you'll be charged tax as well as 10% for early withdrawals. So if you plan to use your investments before you retire, the individual brokerage account is the way to go. Another thing to mention is that you can only contribute $6,500 a year to an IRA account, or $7,500 if you're over 50. So if you're going to use these funds before you retire, or you want to contribute more than $6,000 to $7,000 a year, you'll need a standard individual account anyway. Let me know in the comments below if you'd like to learn more about 401ks, IRA or Roth IRA, or other types of accounts, and I'll be happy to make a video about those. But before you start to invest, it's very important to prepare yourself and have some basic understanding about what investing is. Investing is kind of like betting on different future economic scenarios and the potential growth outcomes for companies or assets. There are tons of books about this subject written by famous investors, including legends like Warren Buffett and many others. For example, when I was just starting, I really enjoyed reading The Intelligent Investor by Ben Graham. I will add a list of great books in the description. I definitely recommend reading a few books before you start. It will give you an understanding and, more importantly, a feel for what investing is about. It will also prepare you for a moment when your position tanks by 20% and you have to keep holding it, or vice versa. When you get a 50 to 100% return and you need to sell your position, it will also give you the feeling that this is the right moment. It's tough to give you the full spectrum of feelings before you try it yourself, especially when your portfolio goes in the red zone and you start to lose money. It's something that you have to practice and experience yourself, but those books will definitely help you with that. In some ways, you can compare this to training in a gym, where consistency and knowledge help you to achieve your results over time. You need to understand your investment strategy and be mentally prepared to execute it correctly. The majority of bad investments happen either because of a wrong investment strategy or a wrong mental decision, like when people sell at the wrong time or they buy something at the wrong time. You've probably heard this principle, sell high and buy low. However, identifying this correctly is very hard to do. In the majority of cases, time in the market beats timing the market. If you miss 5 of the best trading days in the market during that year, you will lose most of the gains that you could make. So the longer you stay in your positions and the better positions you have, the better your chances of getting good gains. That's why it's usually recommended to stay invested long term and not to make random moves. In the long run, the stock market just goes up, and quite often you just need to wait until your positions recover if they lost a few percent. That's why for beginners, it's better to start with diversified solutions like ETFs or purchase very low risk stocks from the best known companies. That's because they have low risk and lower volatility or price fluctuations, and they're less likely to go in the completely wrong direction. Usually these companies are called blue chips. Even if they tank, they'll usually recover within the next 3 to 6 months. Okay, so now you know why you might want to invest in the stock market, and you should also know what type of account you need to open. But what do you actually buy and how to decide on the right investment for you? There are a bunch of different strategies for this, but these are 5 of the most common steps. Number 1, understanding your investment horizon. Suppose you need your money in a couple of weeks. In that case, it might be a bad idea to invest in risky and volatile stocks that might fall by 20% tomorrow. It's better to go after something more stable. However, if you're investing for 10 years or more, it might make sense to invest some speculative portion of your portfolio into some breakthrough technology that might give you huge returns at some point in the future. The second thing is diversification. Even if you have all the information about the market and a specific company, there is always something that can go wrong. So diversifying your portfolio across different kinds of investments is always a great idea. Number 3, cash on the side. It's always recommended to have between 15 to 30% of your portfolio in cash. First, you can use this cash in case you see some interesting deals on the market when one of your favorite stocks fall hard, but you still believe in the future of the company and want to invest more. Or you just found a very interesting investment idea that you would like to go for. Second, in case of an emergency with cash on the side, you won't need to sell your positions, especially if they're in the red zone. Prepare your investment strategy. When I say investment strategy, it doesn't have to be very complicated. For example, investing 80% of your portfolio in the S&P 500 and 20% in some stocks is a very simple strategy anyone can use. However, it's important to have some basic idea of what to do and be very diligent with it. If you don't have a strategy and randomly buy and sell securities, you might find yourself losing money because you won't have any specific vector of investing. Try to understand the companies and ETFs you invest in, at least on some basic level. When something happens in the world, it usually affects specific companies. For example, when the pandemic started, companies related to remote work, like Zoom for example, saw their revenue and stock prices skyrocket. Or last year, because of the war in Ukraine, energy companies got enormous returns. The better you understand your investments, the better you'll be able to make an appropriate decision if it's the right time to buy or sell. The less you understand your investment, the less you should invest in it. So how much money do you need to start? Back in the day, opening an account and starting to invest was really hard, and everything was very manual and over the phone. Today's technology allows you to start within minutes and invest as little as a few dollars. This is possible because of fractional shares, which let anyone invest in companies with very high prices per share. However, when you're just starting to invest, do it with smaller checks, especially if you invest in individual securities. Add slowly month to month as you get a better understanding of the market. Try to feel the market movements and volatility and then invest more when you feel more comfortable and get more knowledge. Thank you very much for watching. Hopefully you've enjoyed this introduction to investing. I tried to give a very broad overview. If you have any questions or you'd like to find out about specific topics, let me know in the comments below and I'll deal with them in future videos. Have a great day and see you soon.